while government rhetoric claims the economy is private sector-led, the actions of government may be doing a great deal in undermining this aspiration. In managing its external debt exposure, government plans are still existent to double domestic borrowing in the excess of 6 trillion shillings. Thus, for the central bank, this explains the low effectiveness of their policy actions to bring down the lending rates.
We need to look at, one, the government appetite to borrow, first of all, from the same market. If you are issuing government securities to finance the government budget deficit, and let's say a one-year treasury bill is 13%, it is very unlikely that the commercial banks or financial institutions are going to lend at 12%, because you cannot be any less risky than government. If anything, they are going to give you a risk premium.
This is affirmation to what is known as the crowd-out effect by government action. Then again, government can make it hard for the banks to lend to the private sector by not meeting its obligation.
Arrears payment by government. You have some suppliers who have supplied goods and services to government, but their monies have been paid either because the arrears has not been verified or for another reason. So all those things are in there. Now, if you had borrowed money from a commercial bank for the purpose of supplying government goods and services and you haven't been paid, it means that loan is now a problem. So there are many factors that enter into the determination of the lending rates beyond just the policy rate.
The over 5 trillion shillings locked away in the cases of commercial court between the banks and the borrowers does not help the situation. So, if you are a private sector borrower, getting more affordable money from the commercial bank seems to remain a difficult thing, at least for now. Ndagire, NTV Business.